So do you want to now maybe share your views just on equities and bonds, given everything we've discussed, and then we might talk about one or two other little things, JP?
Yeah, sure. Maybe, I mean, the conversation in equity land has to kind of almost start with AI.
Yeah.
Because it's the kind of
which I was going to ask you to talk about next, but if you want to talk about that now, yeah, go for it.
Well, it's just that, the whole NVIDIA thing, my obsession and fascination with NVIDIA now over several years. And I describe it as the Magnificent One because, of course, we have the Magnificent Seven, which obviously includes, Apple, Microsoft, Google, and the likes, etc., Meta, and so on and so forth. But really, the standout of the Magnificent Seven is, of course, the Magnificent One and the most magnificent CEO on planet Earth, which is obviously Jensen Huang. I urge everyone listening to this to pay attention to every single word that man says. And by the way, the President of the United States calls him in the middle of the night on a regular occasion, asking his advice on various things. And by the way, whenever Trump goes anywhere in the world now, guess who he takes with him? Jensen Huang. So, this is the new world that we live in. And AI as a phenomenon and as a technological kind of revolution, I think is durable, it's real, and we're in the early innings of it. It begs the question then, okay, fine. Everyone kind of knows that. What about valuations? And I've said this for a long time, that NVIDIA, if you look at it on a 2-year forward PE basis, and I've said this many times in my report, is actually not that expensive. And I think, Eugene, you and I had a conversation. If you look at the 2-year forward PE of NVIDIA, compare it to Commonwealth Bank of Australia, which I call the Commonwealth Bubble of Australia, the 2-year PE rate is about equivalent of CBA and NVIDIA, which is, I think, staggering. But anyway, so from a valuation perspective, I don't think NVIDIA is that overdone. But of course, the big number that everyone keeps talking about is its market value. And so obviously NVIDIA recently surpassed a total market value of $5 trillion. I mean, it is staggering. I mean, feels like 5 minutes ago they were $1 trillion company. Anyway, here we are. Now, the big question mark, Eugene, is about the hyperscalers, the Metas, the Googles, the Microsofts, and this huge capex boom, and whether or not we're going to get a return on invested capital. The whole conversation on Wall Street is, okay, fine, AI is real. We get that. All these massive hyperscalers think that this is a once in a lifetime generational thing to get ahead and be a big player in it. Therefore, we need to spend a lot of money on AI infrastructure, data centers. But the amounts of money being spent are, many hundreds and hundreds of billions of dollars. And in all of their latest earnings, they all upgraded their capex for 2026. Meta in particular. Come back to them in a second. So that begs the obvious question. It's the only question. And that is, will these companies get a return on that massive increase in invested capital? And the jury is out on that. So that AI a bubble is predicated upon that kind of fulcrum of that debate. And my view is, I'm a believer, so hands up, I'm a believer in AI. I think the way to play it is to be in the name or the company that is making the hardware that is required to build and drive all this compute that is now being generated in these data centers. And happy days, Microsoft spending all this money on new GPUs from NVIDIA. NVIDIA is the net beneficiary of that. Yeah. Then you've got some crazy things like Palantir, which I wrote about recently in one of my reports, so my subscribers will know that story. I mean, that, however, went to nosebleed levels. So we had price to sales ratios, not price to earnings, price to sales, well in excess of 100 times. You've got to draw the line somewhere. You've got to draw the line, even though Palantir is an extraordinary company. So I agree, there are pockets of excess in the AI story, but the fundamental foundation of the AI story, I believe, is intact, namely that we need to generate and build this huge amount of compute that will deliver AI to companies and households and countries around the world. So there's that kind of AI bubble thing. Now, we also know at the same time, look, I agree, valuations in the United States are very stretched in absolute terms, in relative terms, and in historical terms. So totally concur with that. And then also we know, if we just want to drill down into the kind of forensic side, put call ratios. The amount of people buying call options versus the number of people buying put options at extremes, at bullish extremes, meaning much fewer puts being purchased relative to calls. And then we look at cash balances, then we look at concentration risk, then we look at the United States as a percentage of global market capitalization, all these numbers near extremes. Then we look at the Buffett indicator, which is total market value relative to GDP, off the map. So absolutely, there's a lot of red warning signals. So my view on this is as follows. you don't just have to be in the United States. There's other pockets of the world where and we've had this conversation now for many, many months, Eugene. Emerging markets are attractive, very attractive in my view. And by the way, I think the emerging market, if you look at the ETF, the emerging market index, EEM is the ticker, we're literally at the all-time highs here, and I think we're going to break through. So I'm still fundamentally positively disposed towards emerging markets. So you don't have to have all your eggs in the American equity basket. I mean, there are other options. I don't think I've answered your question. Bring me back to the question.
Oh, you sort of have. We talked about AI. I was going to go to AI next, but we've discussed that, and it was just around your overall views on equities and bonds, given what we've discussed, and you've kind of answered it. It's from what I'm hearing from you, you believe in the AI story, but it's not going to be perfect, and and the sort of valuations on the grandparents of AI, let's call it, your Nvidia's, is reasonable when you think about the broader, when you think about the story, when you think about their earnings history, and you think about broader valuation. So they're not at sort of ridiculous levels of valuations got to just before the tech wreck 25 years ago or so, but they're high. And then, but the thing about, and then we talked a little bit about the AI bubble. The thing about the AI bubble, Jonathan, is I'm expecting there to be a lot of stocks, or a lot of companies that sprout up looking to take advantage of this AI boom, and for the market not to know how to price. And that's where we could get a bit of. I don't think you think, and correct me if I'm wrong, JP, but I don't think we think Nvidia is anywhere near bubble territory, unless there's a big shift. Like, one of the things that could happen to a company like that is someone comes out and surpasses their technology. From everything we see, we don't see that as being likely, because there's a big gap between what they can do and what most of their competitors can do from what we can see. But then, so there'll be a lot of AI companies that will come up, will have a great story but may not have a lot of substance, and markets can put obscene price tags on some of these things. Particularly, we're not going to talk about this today, but particularly when you've got such a large segment of the market that's retail, and perhaps not as well informed and not as well researched as institutional grade investors, who get it very wrong too, right? But it's a little bit different. So that's that part. But then maybe you want to comment on the rest of the market, which you kind of have in your statement about emerging markets. And we've talked about emerging markets for a while. We've had a healthy allocation to emerging markets for a long time, which is proving to be really good now. But have you got any more broad thoughts on equities? I mean, they're pretty close to their all-time highs. They've made a record number of all-time highs this year, particularly in the US market and the Aussie market. So do you have a more broader view of equities?
Yeah, I would be very cautious on Australian equities. I think Australian equities are very, very expensive, whichever way you look at it. If you look at PEG ratios, that's the price to earnings growth multiple, as distinct from price to earnings. I mean, on a PEG ratio basis, Australia's one of the most expensive in the world, if not the most expensive, because we've got very anemic earnings growth expectations, accompanied by very high prices. And the poster child there is, of course, Commonwealth Bank of Australia, which has, obscene price to book levels and dreadful price to earnings to growth multiples. So yeah, I mean, we kind of know the CBA story. Eugene, you and I have spoken about this now for some time.
Yeah.
But the bottom line is, Australia is an expensive equity market, and I just don't know where they're going to get kind of sensational earnings growth out of the market in the next 12 to 24 months. Whereas when I look at the emerging world, I think the fundamentals in the emerging markets are so much better. And we spoke a long time ago about this incredible situation where the fiscal ratios of the emerging world, excluding China, let's put China on one side, in the emerging markets is better than in the developed world, which has led me sometimes to very, very cheekily refer to places like France and the UK as sub-emerging markets, as distinct from developed. But yeah, so Australia I would put in the expensive category in terms of a global equity portfolio led by, of course, the most expensive bank in the world, CBA. And then emerging markets, I think are quite attractive.